After 2 decades of legal and political turmoil, the final judgment has been delivered. The Supreme Court has ruled in the landmark Shin Corporation share tax case, overturning previous decisions and ordering the former Prime Minister Thaksin Shinawatra to pay a multi-billion baht tax assessment. This is a story of corporate empires, offshore trusts, and political power. To understand this decisive ruling, we must first trace the origin of Thaksin's original business empire, founded on the strength of the telecommunications giant Advanced Info Service or AIS, which was part of the Shin Corp Group. The dispute focuses on a crucial year 2006. At the time, Thaksin was legally barred from holding company shares while in political office. To circumvent this, the shares were held by an offshore firm called Amperage, registered in the British Virgin Islands. The critical moment came on January 23, 2006, when Amperage sold large amounts of Shin Corp shares to Thaksin's children, Pan Thong Tha and Pin Thong Tha. The price they paid was nominal, just 1 baht per share. Crucially, the children then immediately sell these shares on the stock exchange to Singapore's Temasek Holdings at the full price market of over 49 baht. Now, ordinarily, selling shares through the stock exchange would not trigger capital gains tax, but the Revenue Department argued that the purchase of shares at the deeply discounted 1 baht price constituted taxable income for the siblings, as it was an off-market transaction designed to shift the profit. This massive sale, valued at over 73 billion baht, sparked widespread political protests and ultimately helped precipitate the 2006 military coup. The legal case stalled until a separate ruling in 2010. The Supreme Court declared that Thaksin remained the true owner of the shares, with his children merely serving as nominees, holding the asset on his behalf. While the siblings forced the tax assessment, which prompted the Revenue Department to seize assets including cash and property, the key legal question remained unresolved. When the tax case threatened to expire in 2017, the government under the General Prayut Chan-o-cha was determined to collect the money. Officials changed strategy, pursuing Thaksin himself by invoking civil law that holds a principal responsible for the action of their agent. They issued a new personal income tax assessment to Thaksin for the year 2006, now totaling 17.6 billion baht. Thaksin challenged this new demand. In the subsequent years, both Central Tax Court and the appeal courts agreed with him, but purely on procedural grounds, stating that the Revenue Department had failed to issue a necessary legal summon before the assessment. And that brings us to this week, November 17, 2025. In its final appeal, the Revenue Department won at the highest level. The Supreme Court overturned the previous rulings and ordered the tax collection to proceed. The court's reasoning was clear. The entire arrangement was a deliberate attempt to conceal ownership and gain a tax advantage. They explicitly stated that transaction was a serious unlawful scheme that lacked any genuine economic purpose. This judgment provides the final Supreme Court conclusion to the Shin Corp share tax case, a dispute that has spanned 2 decades and shaped Thailand's political and legal landscape. Nonglak Ajana Panya, Tamarin Somha, The Nation.